James Hardie, the materials supplier, has cut its earnings forecast for FY23 for the second time. It's expecting weakened housing demand for the remainder of the fiscal year, with labour shortages and unfavourable weather constraining the market domestically. Now expects net income between 650 and 710 million US dollars. It's also going to buy back shares of up to $200 million through to October next year. Net income for the quarter hitting close to 176 million, up from last year, but well below expectations. And as far as its share performance today, well, it has been hit hard. As you can see, it sold off dramatically, off almost 14%.
Wow.
So, Rudi, interesting way forward then. Particularly, I guess, it's also got to focus on that renovation market, which, what I guess, has some resilience as far as the economic cycle is concerned. So how are you seeing the way forward?
Well, let's start with the positive news. This is, by many people regarded as potentially, probably, the highest quality cyclical we have on the stock exchange. I mean, and it might be competition with the likes of BHP, but nevertheless, it's a quality company, quality management. The product, I mean, we did some renovation at home. I have the product at home. I can bring you a piece if you want. It's a beautiful product. They're still increasing their market share globally, whatever. We always knew that Europe was going to be weak because if there's one region for recession, it's the UK and Europe. The surprise today, however, is that it's not Australia, it's the US, where basically the volumes are lower and cost inflation. I mean, it's really costing them on the cost. They can't keep the costs contained. Those are very big disappointments, and the question now is, of course, is this a forebearer of more difficult times ahead? Because particularly in Australia, for example, analysts who cover the building industry here are for the time being convinced that price falls in properties do not correspond with a drop-off in demand for construction and for building products. Now this seems to be a different story in the US. So I would say second profit warning, bad news usually comes in 3. Risks too high here, I think, unless, I mean, if you're sitting on the stock here and you don't want to sell at a loss or whatever, ultimately a company like James Hardie, they will get their act together and the cycle will turn and stuff like that. But the offset of that is it might take a while. You might have to wait 6 months or longer. So I would definitely not jump on here because for me the question marks are too high, and at the end of the day, it still is a cyclical. But I can see the rationale where you go like, well, I mean, at some point this becomes a buy and the cycle will turn for them. But not for me at this point in time. I would not buy here.
All right, but if you're
too many question marks. But if you're holding, I mean, I can see the rationale. They pay a dividend. They're going to support their share price by buying in their own stock. But you may have to be patient. I would not sell here because I mean the losses are what they are, and this might well be the low for a while.
All right, Mark, where you focus on locally, the US,
well, that's
Europe?
The trouble is you can't, because the business is a multinational business, and that actually makes it problematic from a shareholder point of view, because there's a lot of moving parts. This is a complicated business. I tried to read their report this morning, and I started glazing over it because you have to concentrate, because it talks about each market. There's clearly a significant impact of inflation in their costs. Their costs are going up, wages are going up, and they haven't been able to push that through into sales. Now, maybe that's because of existing contracts, I suspect. Doesn't mean they can't get the inflation charged out, but they dropped. Part of the reason their earnings were adjusted was because they had inflationary impacts on their cost structure. So going forward, that might not be a problem, but we've talked about this before on the show, and it is a real risk for businesses on can they get the inflationary cost inputs charged onto their clients or not. And if they can't, then it's a big problem. It's a quality company. I agree with Rudi. It's got a very good return on equity. It's over 30%. Return on capital is over 20%, which are outstanding. If you look at its growth rate over time, I'm looking at a 10-year graph, they've averaged about 13% EPS growth rate over the last 6 years with pretty good stability. Even for a cyclical, that's good. So we're showing it returning on a margin of safety if it continues. Forget about what they've just announced. If it just continues doing what it's been doing on average, of about 8% a year on safety and up to 20% on default if things go well. So there's nothing wrong with that. So I agree. I wouldn't sell it. It's paying about a 2.8% dividend. They're doing a $200 million share buyback, which to me, I don't think the share price is that low that makes it a bargain. It's on a 24 PE at the moment, which is not low, but it's in its green. So James Hardie typically has a range of 15 to 40, so it's quite a broad range. So at the moment it's in the bottom quartile, which at 24, which is still pretty high. So there's PE contraction potential if interest rates keep going up as well. So that's there. I look at it and say, what do I think on balance? Does it have more headwinds or tailwinds going forward? Because the cyclical business in different markets at different times. We've got a lot of rebuilding. Building's still booming in the US, but you could probably argue the US is probably at the top of the cycle. So that's not good. So it's already had its good times there. Australia, we've had lots of floods and stuff, so plenty. Look, I think James Hardie will be fine in the long term. 14% off today is pretty significant. If you like the business, that's probably not a bad entry point to buy it, but it's not a Teaminvest one. We've never actually voted it up.
How about longer term? You speak of housing.
5 years.
The government wants to build 1 million homes. Immigration rate's going to go up, or is that too far in the future?
No, not on a five. That's the thing. The market reacts like they came out with a profit downgrade, so the 14% came off the share price. So there was more sellers than buyers. True today.
Yep.
So was that an overreaction? Who knows? Probably. And you're right. There's lots of things happening, but there's lots of moving parts. So I'd have to look at it and say, overall, am I more confident in the next few years for James Hardie to say it's a good buy now? Maybe you're right. It's not. It doesn't look bad on our multiples, so it's not expensive. But look, for me, I would be a pass. So I'd say hold if I had it.
All right.
I think one of the things to take home here is I think we're going to see a lot of that between now and February. The cost inflation is of course a big challenge for a lot of Australian companies, and this is investors tend to think about only in top line growth, like the sector's doing well, they're selling their product, but if the bottom up cost inflation is a problem, then a lot of companies will disappoint between now and February.